as per some experts, there are up to 80% chances of a recession in next 12 months in US. Last 9 recessions have lasted for an average of 11 months. In 2008, when we were hit by recession, the revenue growth and margins were affected for a period of 4 to 5 quarters. In terms of price fluctuations, Nifty IT index had fallen by 50% in that 1 year. The impact of recession on Indian IT sector this time around is expected to be a lot less severe due to 3 main reasons. Hi everybody. This is Ankit and today we'll talk about recession and what it could potentially mean for TCS and the great Indian IT sector. We will look at why there is so much buzz about recession right now, what's the likelihood of having a recession in near future, and if a recession actually happens, how long will it last and what it would mean for Indian IT industry. We'll also look at Indian IT services giant TCS and most importantly what we should be doing in this stock. So let's get started. So why there is so much buzz about recession right now? The answer is inflation. Inflation across all countries has been rising for last 2 years. This is primarily because of the low interest rate environment that central banks created at the time of COVID. Supply chain disruptions due to Russia and Ukraine war is also one of the reasons for high inflation. Now to control this inflation, Fed and other central banks have been raising interest rates. Fed has already increased interest rates by 3% since March this year, and it is expected that Fed will increase rates by another 1.5% in next 5 months. Higher interest rates have 2 implications. First, loans and EMIs become expensive. So, people delay their purchases and businesses delay their expansion plan. Due to this, demand for goods and services in the country reduce and GDP for the country declines. A subsequent decline in GDP for 2 quarters is what we call a recession. Second, with higher interest rates, savings and deposits become more lucrative. So, money moves from equity markets to debt instruments, leading to a decline in stock prices, which is what we are seeing right now. Now, the question is there a recession every time Fed increases interest rates? The answer is broadly yes. Every time Fed has increased rates consecutively for many months to control inflation, there has been a recession in the subsequent year. So going by historical data, the chances of recession in 2023 or early 24 are significantly high. In fact, as per some experts, there are up to 80% chances of a recession in next 12 months in US. Now you may ask Ankit, if there is actually a recession, how long would it last and how will it affect our IT industry? Well, that's not a very easy question to answer because every recession is different. But what we know from history is that the expansion periods that follow every recession are much more powerful than the recessions themselves. Last 9 recessions have lasted for an average of 11 months. Whereas the expansion periods that followed them have lasted for an average of 64 months. The shrinkage in GDP in the times of recession is of much smaller magnitude than the growth in the times of expansion. So yes, in all likelihood, there will be a recession in next 1.5 years, but if we plan our investments well, we may not have to stress so much about it, which is what brings us to the next section in this video. Now let's look at what could be the impact of recession on Indian IT industry. Indian IT industry is primarily an exports-based industry. 80% of our revenue comes from exports. So if there is a slowdown or a recession in US and European countries, the earnings growth of Indian IT companies could also decline. Let's dive deeper and see if this recession is actually a serious threat for Indian IT industry. To begin with, let's look at some historical data. In 2008, when we were hit by recession, the revenue growth and margins were affected for a period of 4 to 5 quarters. These numbers started improving swiftly after that. In terms of price fluctuations, Nifty IT index had fallen by 50% in that 1 year. But once the recovery started, the index gave 350% returns in next 2 years. So yes, there was an impact of recession on Indian IT industry, but it was short-lived. Now, does that mean if we have a recession, we'll have same impact this time around as well? The answer is no. The impact of recession on Indian IT sector this time around is expected to be a lot less severe due to 3 main reasons. First, COVID made it very clear to all businesses in the world that in order to stay relevant, they need to invest in IT. Around 80% of the businesses globally are expected to move to cloud in next 5 years from 20% currently. This replatforming of global businesses is once in an era opportunity for IT service companies, and this is expected to continue even if there is a slowdown. In fact, IT spending in all industries is increasing regardless of growth of industry itself. Second, companies globally are focusing on automations and cost optimizations by using AI. These optimization projects are aimed at improving margins. Cost optimizations become even more relevant when inflation is high and there is a recessionary environment. So we expect the demand to continue there as well. Finally, tech unemployment in US is at a record low level. The shortage of skilled talent is forcing the companies to go the outsourcing way, and this is something that drives demand for Indian IT sector. Also, due to inflation, The demand has been shifting to Indian IT companies, which is evident from India's increasing market share in global IT industry. Going by all these growth drivers, Indian IT industry looks well positioned to navigate the recession safely. Rishad Premji, who is chairman of Wipro, has even gone to an extent to say that Indian IT industry is recession proof. But realistically, there can be some moderation in growth and earnings in near future. If there is actually recession and there is a sell-off in global markets, Indian IT stocks may fall further by 10 to 15% from current levels. But if you have 3+ years of horizon, these stocks are expected to give good returns because fundamentals are quite solid and the outlook for this industry is positive. So now let's talk about TCS specifically. But before that, if you have liked the video so far, please subscribe to the channel for more such content. TCS is the largest IT services company in India and is a gold standard by most metrics. But the company's share price has fallen by 20% in last 6 months. Let's see why is that the case. First, the company has reported an EBITDA margin decline of 2% in the last quarter. There are primarily two reasons for the EBITDA margin decline. First, due to shortage of skilled labor in US and European countries, TCS had to hire more subcontractors. The talent shortage could not be supplemented by Indian employees because of visa restrictions. Second, IT industry is facing very high attrition right now. This is because of high demand for IT employees, high pays offered by startups, and a reluctance to return back to office after COVID. Due to higher attrition, TCS had to spend more to retain the employees. To tackle the margin pressure, TCS has hired 1 lakh plus freshers in last financial year. The company is planning to hire another 40,000 freshers in the current financial year. TCS has been through many such high attrition cycles earlier as well. So ideally, attrition should come down over the course of next few quarters. Moreover, due to possibilities of a slowdown, many startups have started laying off employees. This will also help larger companies like TCS reduce their attrition. In fact, the subcontractor cost should also come down now because many countries have started removing COVID restrictions. Finally, TCS management also looks very confident of reaching back to EBITDA levels of 25% by the end of this financial year. So margin decline was the first reason for stock price fall. The second biggest reason for a stock price fall is the fear of slowdown and recession in US and European countries. However, this fear may not be justified. Digital transformation of businesses globally and investments on cost optimizations are expected to keep the demand intact for TCS. TCS's business is well diversified geographically and across verticals. The company services large clients that are unlikely to go out of business due to recession. In fact, these large clients tend to move all their IT projects to a single big supplier at the time of recession to cut down their costs. This is called vendor consolidation, and this works in favor of large cap companies. That is why large cap companies tend to do better at the time of recession compared to small cap companies. Finally, the last reason the stock is falling is because of the price corrections after a long run-up. Like pharma, IT was one of the first sectors to recover after COVID. Now, as other sectors have started to recover as well, traders and momentum investors have started booking profits in IT and they have started moving their money to other sectors and asset classes. The same trend is visible in Nasdaq index as well, which is very closely related to Indian IT index. None of these reasons for a stock price decline that we have seen is a red flag for TCS's core business. In fact, if we look at TCS performance, it is probably the best IT sector stock to own in these times of high uncertainty. Company's attrition rate is best in industry. Company's subcontractor costs are lowest in industries. Company's salary cost is one of the lowest in large cap companies. All of this has helped TCS maintain highest EBITDA margins in the industry. The book to bill ratio is also impressive, indicating a strong deal pipeline. The company is now focusing more on consulting projects and platform products. This will help company improve its margins and revenues per employees. As we can see, the same trend has played out for global IT major Accenture as well. Most importantly, as per company's management's commentary, they have not seen any signs of slowdown on TCS's business as of now. So from a fundamental standpoint, TCS looks like the best defensive play in IT segment. The stock is currently available at 25% discount from 52-week high. It is trading at a valuation which is just 6% premium to long-term PE average. In short run, it is possible that the stock corrects another 10 to 15% due to a sell-off in global market. There may also be pressure on margins in short run due to weakening European currencies. IT sector and TCS have had periods of sideways movements as well in the past. But I am bullish on long-term prospects of this business. I consider the current correction a good opportunity to start building your position in TCS. I would add this stock in a staggered manner for the next few months till it continues to trade below 3,200 levels. Let me know in comments which is your preferred stock in Indian IT sector. That's all I had in this video. I have also analyzed a small cap packaging leader which you can watch next. Thank you.